All right, welcome to the quarterly active allocation presentation, our review of the economic and market outlook and how things have gone over the last quarter and our expectations for things we're planning on for the quarter ahead. Glad to have you joining us, and we'll jump right in. Brian Regan is our Chief Investment Officer. He'll be joining me throughout the presentation. He's prepared a great deal of content for our presentation today. I'll start things off and turn things over to him shortly. Our plan for today is to reiterate some of the things we've been talking about over the last quarter, and as well, viewing things in a two-act play. And that's sort of the way things seem to be shaping up. We've had, we'll review one act, Act 1, where what's happened in the last quarter, some of the uncertainty that we had been concerned about, some things that might have been holding the market back a little bit. And as those have resolved, we've seen some notable market response. So we'll go through all that. And then Act 2, where we see things going. We'll talk about some of the economic data, both good and bad, and how that might be impacting our investment decisions. And of course, we'll review what the primary takeaways will be for the quarter ahead and perhaps the year ahead. So Act 1, Brian, why don't I turn things over to you and you can take it from here for a bit.
Yeah, thanks, Chris. Act 1 we talked about as a time of relative uncertainty. We did not know what the makeup of the government was going to be. We did not know if there was going to be a stimulus package. But we had some expectations, and we did think that once we got through a lot of the uncertainty, that there would be a little bit of runway for the market, and certainly a lot of that uncertainty is lifted. What actions did we take in response to this? We thought that with stimulus, that consumer discretionary stocks would do better, so we positioned portfolios for that. They performed as expected. We've been increasing over the last few quarters small cap positions in ETF mutual fund portfolios. Again, it's performed as expected. That was, in response to an expectation that we were going to get a stimulus package and a vaccine, regardless of which political party took over. And finally, we did just increase our overall risk in the stock market, and the stock market had an excellent quarter. So overall, I think Q4 of 2020 capped off a very interesting year for us, and I think that we performed very well throughout the year, and I'm very, very proud of the firm as a whole for our performance in a relatively difficult year.
Brian, I might just echo some of your comments and give you a pat on the back in the process, in that I want to make sure that our clients know that we have plans each quarter as we reveal through these webinars for the things that we intend to do, or as we see what's happening and forecast a little bit what we might want to do. But it's also been a great opportunity where you've seized opportunities as they arose. We had such a volatile market last year, and with that came opportunities. And both in terms of planning for taxes, tax loss harvesting, as well as where there were displacement in the market, there were some significant opportunities along the way that you took advantage of for our clients and their discretionary portfolios. So maybe I'll review this page a little bit. It's with this year being, last year, 2020, being such an unusual time with the coronavirus. It's been a challenge, of course, for people in their just daily routines and worries for the mortality and so forth. It certainly, had the reality of it all is before us, but it's important to recognize that there's a financial dynamic to that as well. We'll talk a little bit about that. I thought I'd just touch on some of the history and the stats as it stands right now. Where we're at today is much worse than where we were back in March when we had shutdowns and so forth. When it comes to the number of reported cases by day, it's just drastically higher. When it comes to the number of deaths per day, I think we were in excess of 4,000 deaths a couple of times this week in a single day. And of course, the hospitalization rate is one of the things we're paying attention to. We're fortunate right now on Cape Cod. We're closer to around 50% or so, 55, I think it was, in terms of our ICU capacity being utilized. So that's encouraging. It's not, we're not at capacity, but that's one of the things people worry about is if as there's more cases of COVID, that it strains the intensive care units and then can increase the mortality rate as time passes. So things to be watching for.
So we do have some good news, though. We, as we hoped going into the quarter, we did get some vaccines, most notably from Moderna and Pfizer BioNTech in the United States, and with efficacy rates well into the 90s. So we have a lot of optimism for how they're going to impact herd immunity going forward. AstraZeneca also had a vaccine that has efficacy between 60 and 90%. They do have some data issues when it comes to reporting their test results. But we do think that they can mass produce their vaccine a little easier, and it's probably going to go into the developing world more than the developed world. But they are using it in the UK as well, which has led the world right now in the number of vaccines that they are actually being able to distribute. Here's an interesting chart, I think, where Fidelity Investments got this from COVID-19projections.com. It estimates where they think that we'll get to herd immunity, which of course you could expect life to get back to where we were in 2019. Remember those days? So it looks like by this projection at least, and it makes some reasonable sense to me that by early summer we should have some optimism. And also we know that in the summertime it's a little bit more difficult for the virus to spread because people are generally outdoors rather than indoors. So this all goes to say that we might have a bright second half of the year economically. Chris, you want to take on the
sure. So that's good news that as much as there's challenges now, there's light at the end of the tunnel, and it's coming soon. With regard to this past quarter, there's certainly been a lot of emphasis on the politics of the nation, and so we wanted to reiterate some of the results of this. So naturally, the election, the presidential election, was a big part of the focus and a lot of the attention we've had. Obviously, the results of the Electoral College, with much fanfare, but did result with 306 for President-elect Biden and 232 for President Trump. So, there will be a Democrat in the White House. When it comes to the other parts of government, when it comes to the House of Representatives, it's much closer than was expected, where Republicans picked up more seats than had been anticipated. So a tighter role there, 222 on the Democrat side, 212 on the Republican side. Makes things a little bit more challenging again for, even though it's going to be, a Democrat control, it's going to require perhaps more collaborative government than we've had the need for in the past in the House of Representatives. When we look to the Senate, there is a 50-50 split. Really, it's there's two independents that caucus with the Democrats, but so let's call it 50-50. And so now that leaves us with Democrat control by virtue of the vice president's tie casting ability for voting. So it's all Democrat control, but it's a razor thin margin. And that leads us to think that there may be more challenging to push through some of the policy agenda, despite having the advantage to the Democrat Party efforts. And so let's talk about policy, Brian.
So we put together this chart a few quarters ago when discussing the differences between Biden and President Trump's plan. So the government's already passed a $900 billion stimulus plan. President-elect Biden proposed a $1.9 trillion additional stimulus plan yesterday. So that is about in line with his $3 trillion that he had originally planned in his, on his website, his campaign promise. And ultimately, we do think this is going to be better for risk assets. It could have an effect on inflation, and it probably will have a negative effect on investment grade bonds. But it'll probably have a positive effect on unemployment as well. He does have a plan to raise corporate taxes. I think there will be a lot of debate around this area. Like Chris discussed, that there is razor thin margins, and certain senators, like particularly Joe Manchin of West Virginia, this will not be a popular item. But I would expect that he's going to raise the corporate tax rate, from some degree, from the 21% it is now to something higher. He does have a plan to raise the minimum wage, manufacturing innovation, and gigantic clean energy plan on top of his coronavirus stimulus plan. So there's a whole lot of stimulus here, and our base case is that stimulus will be so dramatically large under this plan that it would really drown out any change in corporate taxes. So it would ultimately be a good thing for risk assets, but could pose other concerns like inflation and higher interest rates on bonds.
I'd just like to comment real quickly on that. And that is the idea that, we're looking at this from the perspective of how are policies likely to, and it's important for us to be able to continue to assess how likely are proposals to become enacted into law. But we're looking at this from the perspective of how are these policies likely to impact different investments, and where are we likely to see benefits. And it's important for investors to recognize, despite whether they might favor or disfavor certain policies, there may be winners and losers in the process for our investment portfolios. And our expectation is that we're going to be looking for where's there opportunity, or how should we alter the portfolio, whether it's for offense or defense in a sense. So
I heard a good quote this morning, Chris, that said investors aren't on the blue team, they're not on the red team, they're on the green team.
Yeah, that's a great, yeah, I like that.
How we approach this.
That's the point exactly. So we did hear last night that the president-elect has announced an American Rescue Plan, is what he's calling it. Pretty substantial $1.9 trillion virus relief package that it has a variety of aspects to it. And whether it will pass in full or in part, we'll be watching. But to your point, Brian, it's immediate stimulus, it's dramatic, and that's likely to have some economic and market benefits right out of the gate.
Yeah, and this is really the reason why we did make that consumer discretionary and small cap positioning, or at least part of the reason the vaccine would be the other reason. So I do think, people hear higher taxes, they ultimately do get concerned. I think it's important to let's look back and see what has happened when taxes have been raised in the past. The data says that stocks don't react to tax increases. People do not make wholesale changes to their portfolios due to certain types of tax increases. This has personal, corporate, and capital gains and a baseline. Miraculously enough, the market actually performs better when taxes go up historically. Granted, there's a lot of variables that go into stock market returns. So I don't want to suggest that higher taxes means better stock market returns. What I want to suggest is just because taxes increase does not necessarily mean that we're going to have an economic or stock market collapse. And I don't think they should necessarily be, we should feel that way.
Yeah, that's an important distinction, but it's a good point to make.
Go into this. So we've been talking about a tale of two markets for a few quarters now, where this is the Russell 1000 growth at the top and the Russell 1000 value at the bottom. The Russell 1000 growth has far surpassed the performance of the Russell 1000 value at the bottom for for really the whole of 2020, but mostly concentrated in the first 9 months of the year. We mentioned that with a vaccine and with stimulus, we would expect a reversal, and we have seen a bit of a reversal where the growth market, this is the last 3 months on the top, has returned plus 10.5%, which is great. But the value side of things actually has performed better than the growth over the last 3 months. It's interesting to look at this dynamic. I do think that when you look at some of the larger growth names, they just got a little bit stretched. They're not necessarily that they're not great companies, but their valuations got slightly out of control, and now I think the growth needs to catch up to their valuations. And you might and where the value side, if you're looking at leisure, hospitality, was just decimated completely, and oil and gas, and it wouldn't be surprising to see a bit of a comeback as the economy comes back to life.
Hey, Brian, before we go on, I meant to mention at the beginning of our presentation that if our participants have any questions, be sure to note that there's a Q&A button that you can register any questions you might have. If there are contents relative to what we're talking about, we'll try to address them as we go. If they're something that is a little off topic, we'll hang on to them until the end of our presentation. So feel free to take advantage of the Q&A button for any questions our listeners might have.
Yeah, so Act 2 here, despite some uproar throughout the country, we are going to have some relative certainty. We do know what the makeup of the government is. We know that we're having a vaccine, even though the rollout's slower than I think we would all hope. There are vaccines available, at least, so we can see forward to herd immunity, looking hopefully in the summer, hopefully earlier. Cross your fingers. And we do know that we're going to have an overwhelming amount of stimulus. The things that are uncertain are the negative things, right? So right now it's uncertain if we're going to have tax increases. So it's it's a macro outlook that it can be very that gives you reason to be optimistic. And certainly compared to what we were looking at in Act 1. And obviously, the stock market's performed very well throughout Act 1, as it was anticipating Act 2.
And people may have concerns about the long-term implications of taking on more debt and more stimulus and all that. Those are not really the points we're driving at today. We're looking more at the near-term
I'm happy
implications.
To address those, if people have questions. Yeah. So I want to talk about economic data. I'm going to go through these slides pretty quickly because they can be a little wonky. But if you have questions about them, if you want me to go back and get into the details about some of them, I'm happy to do that. There is good economic data, there's bad economic data right now, and I want to address both. I do think it's important. But the most important thing right now is we are in a very deep recession, and that's important to know. And it is a K-shaped recovery, as many describe the differences in the distribution of performance right now, where people on the lower end of the spectrum are really taking it on the chin, and people who are doing relatively well already are doing even better. And we're seeing, you can see that in a lot of different data that we're going to go through here. Most importantly, initial unemployment claims are starting to tick up again. I do think this is a response to some of the data that Chris talked about earlier with the coronavirus getting worse. We're starting to feel that in the unemployment line. There was some optimism that we were going to break this 5 million mark on the continued unemployment claims, and we did not. We actually ticked back up again. So we're about 1 million on initial claims, and we're still over 5 million on continued claims. this is really bad. I mean, you really want 2 to 300,000 in a very healthy economy and continued unemployment claims, and we're well over 5 million. This is labor force participation rate, and I like to look at the prime age labor force participation rate, but I think this chart is a little more clear, and they both tell the same story as well. The labor force participation rate is horrible. We fell from 63 plus, which was a bad number compared to where we were prior to the great financial crisis, down to in the 61 area, which means a good 1.5% of the country has basically given up looking for work altogether. So we need people working. We need people to be productive, and this does not bode well for the recovery. Usually, when you see numbers like this, it's going to be a longer, drawn-out recovery. I want to concentrate people on the yellow line here. This is the long-term unemployed, people that have been unemployed for a duration of 27 weeks or more. And there's obviously a dramatic increase there. And that's because a lot of people lost their jobs during shutdown. 27 weeks went by, they're still unemployed. These people usually historically take a long time to get back into the labor force. So, it becomes very difficult to be optimistic about, a V-shaped recovery when you see data like this. This also, dampens your expectations for any kind of fears you might have of imminent inflation when you have this many people unemployed. This is high frequency data. This is a great chart from JP Morgan. You can see that we were recovering from a rock bottom, zero activity in airline traffic. We recovered about 40%, off and on stops and starts. Purchase mortgage applications are above where we were pre-pandemic. So, you'll notice that when we get into this and we talk about where we want to position portfolios, that, mortgage applications and building starts become a bit of a theme. Consumer debit and credit transactions were around where they were pre-pandemic, but have tilted lower lately, as has most of this data. So the recovery that we saw has really dramatically slowed down. I think we're seeing some real negative recent activity. Now the ultimate question is that going to continue? We're expecting to get the herd immunity in July, which might seem like far away, but as far as the stock market's concerned, for sure, 6 months is almost no time. So we need to look at what's good on the underlying economic data, so we can see how robust a recovery could be going forward. This is new orders of durable goods, and it has skyrocketed from the trend that it was in pre-pandemic. So the pandemic is the yellow beige. There is where we started the recession. And you can see that since the CARES Act, we've really skyrocketed. You can think of people that are spending more time at home or doing things like buying Pelotons. That would end up on the durable goods orders type thing. And I know the boys have enjoyed their Peloton, but I have a number of friends who have made the same decision. Retail sales growth.
Kristen's saying one Boyd. She's the one who's really enjoyed the Peloton.
So retail sales growth, we just got another ugly retail sales growth number, but you can see the longer term trend is well above the trend that it was pre-pandemic. So I could expect that with the new stimulus package going into effect, we're going to see another leap forward in retail sales growth. So, I actually went back and forth on whether to put this one on the negative or the positive, because the recent data has been very negative. But with the stimulus, we have a test case on what retail sales growth does with the stimulus package, and it's very good. It's very good news. New housing and building permits. We're going to get into this maybe in the next couple slides, but we've seen savings rates and personal incomes really launch with all the government assistance. And a lot of people are using that new savings to buy or build houses. So, we talked about purchase mortgage applications being well ahead of the pandemic, while the new private housing building permits is also good. So building permits is kind of a precursor to what you would expect for the economy to recover, because it takes about 9 to 12 months to build a house. And then, new housing actually has a lot of knock-on effects in economies because you need to fill the houses. So, it gives a little bit of optimism for the future of the economy. Personal income, you can see the big spike there. That is the CARES Act, and then basically added $2 trillion in personal income into the economy almost overnight. And then it gradually has come down as the unemployment benefits expired in July. Now the trend line has reversed to a more negative place. But we know that we're getting more stimulus, right? So we could expect this to have another nice jump, which will be good again for retail sales. It'll be good for housing. It'll be good for a lot of the things that we've already mentioned. Personal savings rates, it's up about $1.2 trillion from pre-pandemic levels. This is really quite amazing. There's really two components, if you want to break it down, that has led to the additional savings. There's about $500 billion in people not spending, not spending on leisure activities, not going on trips, not traveling, buying airline tickets, et cetera, et cetera, et cetera. The things that we're all too familiar with. And then in addition to that, the CARES Act provided so much, additional personal income to folks that they were even able to bolster their savings further. So, about $500 billion from not spending and about $500 billion from actually having more cash in your pocket. So, I like to think of this as we're almost like a jack in a box, right? This thing's ready to spring. As all these people with all this extra money in their pockets are given the opportunity to actually go out and have a good time once again, when we're all vaccinated and reach herd immunity again sometime, hopefully by the summertime. We got some great news from the Federal Reserve on the health of the banks. They performed stress tests on some of the largest banks, the systematically important banks in the United States. And when the pandemic started, they did not allow them to buy back shares or have dividend payments. They've reversed course on that. They've allowed all earnings in 2020 to be paid out and back to shareholders in one way or another. So we look at this as the health of the banks. We've been given a rubber stamp by the Federal Reserve that says, hey, look, under some really tough scenarios, we're confident that the banks are going to be solvent. So we can look at investments that might where we might get paid a little bit more, like preferred shares, for example, on holding bank assets, which is something that we plan to do, this quarter going forward. So now we get down to the investment evaluation. I think I'm going to hand over this first slide to Chris because he does a very good job of explaining it to folks, or maybe the next couple slides. But the first, the good economic information and the bad economic information, they kind of paint a picture of where we are as a whole. And that doesn't necessarily mean that investments are valued correctly. We could have a real disconnect one way or another. I don't think we're seeing that right now. I actually think the financial markets are pricing in the expectations and where we are right now pretty rationally. But I'll let Chris take it over from here.
Yeah, well, this slide picks up on that very point because at first glance, what is this showing? This is tracking the forward-looking price earnings ratio of the S&P 500. And what, again, just to review what that is it's how many times multiple of the earnings is the current price of the S&P 500. So right now, it appears really, at a higher multiple over 22.5% times rather, the current earnings. Well, when you look back at 2000, we were in this kind of realm of the extended multiples, right? So at initial glance, it looks like the market's really overextended. But again, this is based on forward earnings. And as Brian was just saying, with the optimism that we might anticipate coming soon into the year, let's say in July or something, it really changes the way we might think about some of these forecasts, that the earnings may be improving dramatically. And that may cause those multiples to become more in line with a more appropriate or historical kind of context. So it may not really be as extended as it appears right now. And as Brian has commented quite a bit on our radio show recently, stocks are long-term assets and they are forward-looking. And so, Brian, why don't you take on elaborating what this presentation is showing?
Yeah, so this slide saying, what are the earnings expectations going to be for 2021 and 2022? And this is from Morgan Stanley, and I have another one right after this from, I believe it's from Fidelity. And they're both saying the same thing. We're going to have a lot of earnings growth in 2021 and 2022. So when you have a lot of earnings growth, you can justify a forward PE ratio that's currently, looking a little lofty. For example, just with time going by, you could see that forward PE come down to some rational level just as we age into this expected earnings growth. So that one was from Morgan Stanley. This one's from Fidelity. This is saying essentially the exact same thing. You can see starting in the second quarter of 2021, in the third quarter of 2021, and the fourth quarter of 2021, we're going to see a gradual, rapid increase in operating earnings. So,
it's worth pointing out, Brian, that these are estimates, and it may, depending on how the vaccine distribution actually works, it could be delayed or accelerated based on how quickly we get to that herd immunity kind of perspective that you were talking about.
Yeah, that's important. And as a general rule, the estimates are usually optimistic by about 10 to 15%. So it's good to keep in mind. When I come up with my estimate, I always discount it by 10 to 15% for that reason. So that is an excellent point, Chris. We have been into small cap stocks as of late, and the reason for it is really this V-shaped recovery that we're going to see in the forward margins. The expectation of the market is that margins are going to go from 3.5% to 5% on small caps, and from about 5.5% to 7.5% on mid caps. So that's a lot of money that's going to flow to their bottom lines in time as we age out of this horrible pandemic that we're in. Here's specifically the forward earnings on the S&P 600, which is small cap stocks, and you can see that the expectations for 2020 are $32 a share. For 2021, it's $58 a share. For 2022, it's $70 a share. So, if this was your average growth stock on Wall Street, this would that we were going to expect a doubling of earnings per share plus some in the next 2 years. It would be trading at a pretty significant, pretty lofty multiple. And right now, the forward earnings per share on small caps is about 20, where Chris mentioned on large caps, it's 22. So this is why, we've been in small caps. This is why small caps are performing right now as this optimism starts to get priced in correctly. Before I move on to the yield curve here, I do want to mention that I do think there are pockets of irrational exuberance in the market, primarily when it comes to IPOs, the SPAC market, cryptocurrencies. I think these are things that you should all be very wary of. When you look at things from a 10,000-foot view, which we have throughout this presentation, the averages look like they can make some sense. But when you get into these underlying individual investments, I do think there's a lot of bubble activity, and that bubble activity could cause some initial volatility going forward. So it's not to think that I think we're going to have clear sailing forever here. I do think we're in pretty good shape though overall. So if you are kind of getting energized by those things that are happening in those markets, I'd just exercise or encourage some caution. This is a chart of the yield curve. The yellow line is 1 year ago. You could see that we were flat, a flat curve, slightly inverted between the 0 and 1 year, and then kind of a slow steepening. And the pandemic has brought us all the way down to 0 on the short term, and now we're starting to see some steepening in the curve. This is basically the bond market saying that they're pretty optimistic about the future. When you get to 3, 5, 7, 10 years out in the economy. But this is also how, you know, bonds are priced. And if we're going to position our bonds, usually you want to do it in the steepest part of the curve. For me, that's between around 4 years. And the reason for that is you get a little bit more coupon, you don't take a lot of duration risk, and you get something called roll return, which is the additional return you get as the bonds age. And then, you know, again, we've talked about how we invest for total return, and, you know, bonds are more challenging right now as yields are so low, but I do think that there's ways to invest through bonds where you could take advantages of the opportunity that the yield curve can give you. So I want to talk briefly about commodities. We've been in gold for a while, and we're going to cut our gold position about in half across our strategies. And the reason for that is, you know, this is a pretty complicated chart, but basically it means when interest rates on domestic, not on developed currencies are converged close to the zero lower bound, you'd expect things like gold can be a store of value when you're not getting paid anything on these currencies. And some of the developed currencies were paying zero. What we've seen recently is a change. So this is the difference between the U.S. and international 10-year yields. We've grown, you know, about 1.1% to 1.2%, depending on what day you look at the interest rates from there. So now you're getting paid a little bit more to be in U.S. bonds than you were previously, where you're getting zero, and versus the international markets, you're getting paid, you know, it's a pretty significant difference, 1.1%. Now, the reason why we're not cutting it completely, we've been in it for maybe a year and a half, year and 3/4. It's done very, very well for us, is because real yields are still negative, which would be bullish for gold, but the trend is not our friend in this situation. So we're going to start transitioning the portfolio towards being more in interest-bearing assets, which is my preference historically, to be in interest-bearing assets versus a non-interest-bearing asset. I showed this slide last quarter. This shows about a big disconnect between energy stocks, which is the bottom one. The XLE was trading at 29.31 last quarter. You know, that's the end of October. Where in the West Texas Intermediate crude was trading at $37.05, where there's usually a symbiotic relationship there. There was obviously a big disconnect, which is one of the reasons, you know, that we were in it in the individual stock portfolios, and in the Core Explore portfolio, we had a pretty decent energy positions. And what we've seen is that relationship come closer into a line. The West Texas Intermediate crude has gone up to 53, and the energy ETF has gone up to 43, 42. There's still a pretty decent disconnect there, and percentage-wise, you know, even though it's closed a little bit, it hasn't closed completely. So if you're on an individual stock portfolio, I'm going to evaluate each stock on its own merits. And but I think in general, you'll probably see them come out of the portfolio more than we'll be adding to them, where we were adding to them rather than taking them away probably for the last 9 months. So, you know, I think overall this is great news. This is the market getting optimistic about a future recovery in the market, and I plan on continuing to hold the energy ETF in the Core Explore portfolios as well. So the Q1 takeaways for 2021: Act 2 will be relatively normal from the news bonanza of Act 1, hopefully. You know, I think we're in Act 2 right now, but maybe I'll feel more comfortable about that after January 20th. The United States is still in a deep recession. Unemployment's high. The prime age labor participation is low. These are bad things. I think that even the recovery will take some time, maybe multiple years before we get back to a real healthy place like we were pre-pandemic. The United States is recovering from the depths of the recession, even though we've had a recent, you know, kind of fallback. Durable goods, housing permits, business starts are actually off the charts, and is a really interesting, you know, data point that I suggest everybody take a look at, because there's about double the amount of business starts than we've ever seen before, which is just remarkable. I don't have an explanation for it, which is why I didn't include it in here, but it is a remarkable data point. stimulus and personal income and the health of the banks is all giving us reason to like what's going to happen here in the second half of 2020. We need to continue to take advantage of the opportunities that present themselves. We have expectations for earnings growth in 2021 and 2022. You might remember back in 2019, I was actually a little down on earnings growth. In fact, we weren't having any earnings growth. So now that, we're certainly expecting robust earnings growth for 2021 and 2022, I think that's great for all investors. We do think there's still relative value in small cap positions, and we think the outperformance there is going to continue. We think there's health in real estate in the banking markets. So you're going to see that we're going to add some additional exposure there when we actively allocate the portfolios this quarter. And we're increasing domestic versus developed market interest rates. So this is the gold positioning I was talking about, right? Where domestic interest rates are moving away from the developed markets interest rates to the tune of 1.1% as of today. And I think there is a lot of expectation from most bond purveyors that the interest rates will probably continue to decline. So like I said, the trend isn't necessarily our friend with a gold holding there. But we've seen some commodity disconnects that we've been able to take advantage of, and I think there are additional commodity disconnects that are going on right now. So I think one of the big things when you evaluate something like a commodity disconnect is you need to decide what's going to be a transient data point and what's going to be lasting. So a lot of stuff there. I'm glad to say goodbye to 2020. I think it was an interesting year. I think for financial advisors, it's kind of the Super Bowl of years, right? I mean, that's kind of what you train for, is to get your clients through a difficult situation like that. And I'm very proud of how we performed. I think 2021 is going to have its own challenges. I think our challenges with 2021 are going to be avoiding the hot bubble activity and sticking towards investments that are solid and based in foundation. As people get, I think people will continue to be very bullish as they have been. So, Chris, I don't know if you have any comments, but I'm ready to take questions.
Yeah, so this is a good time for anyone who would like to ask a question. Just enter it into the Q&A section. I do want to just reiterate some of the takeaways as it relates to how our discretionary portfolios will expect some modest adjustments. Just to reiterate that point, one of the ways we differentiate ourselves in the way we manage our portfolios is there's an element of a tactical nature to the asset allocation that we utilize. We refer to it as active allocation. So we do use asset allocation as a means of managing the risk of everyone's portfolio and try to structure it in keeping with their own risk temperament. And but within that design, we make some adjustments each quarter, not necessarily each quarter, but we look at it comprehensively each quarter. And as I mentioned, even when there's activities in the midst of the quarter, there can be things that we will make adjustments on if markets move materially. But so in summary of the things we're really kind of expecting this quarter, Brian, the takeaways I think from some of the things you talked about are we're going to have modestly, we've had more small cap, we're going to extend that just a modest amount. We're going to really move to stock exposure as opposed to, say, for example, diminish our high yield exposure as one of the ways the changes planned. A little less gold, a little more international, perhaps modestly. What are some of the other overview highlights?
We're adding more real estate and more preferred as we like what we're seeing with the banks are healthy, and there's some nice real estate trends where we're not going to take a ton of risk there, but we think it's a good way to responsibly increase our risk here while also being in a position to add more if we were to get a kind of an opportunistic sell-off. So yeah, I would say we're modestly increasing our risk while taking advantage of the opportunities that the market gives us. And I think that would be, a great way to just sum up what the active allocation really is.
We do have a question from Ron Parker. Thanks, Ron, for submitting that. Household savings is one reason behind market growth in the last 6 months. As the economy comes back, for example, hospitality segment, won't there be a trend for consumers to take money out of the market? What's your thought on that, Brian?
If there's a technical change like that, Ron, I think that would be an extremely bullish event for longer term people who look at stocks as a long-term investment, which I believe is most market participants. Because if people take money out of the stock market to go spend it somewhere, then earnings of these companies are going to go up, and you're going to see an earnings explosion. And ultimately, people are going to want to own stocks of companies where their earnings are going to go up. So I do think that you could see a very nice cycle of people taking their savings down and spending it in the economy. I'd also like to point out, I don't have data on this, but I can send it to you if you'd like. I don't have it in the deck. But most of the flows of new savings have gone to money market funds and bond funds, not necessarily the stock market, believe it or not. And those would have, flows out of there would have minimal effect on the stock market. But I think the most important point that I want to make is small technical changes in the stock market. You shouldn't be concerned about. It could cause, those type of things could cause small corrections or daily changes. But overall, stocks are priced based on the underlying fundamentals of the company's earnings and the interest rate environment that we're in.
I should have mentioned earlier as well that our program is recorded. So hopefully if you're offering comments, you don't mind us keeping that in the content of the presentation. Brian, while others may be considering some questions, one thing I thought might be worth reiterating was you were talking about the good and the bad in the economy. And I imagine that some of our clientele would find it puzzling. On the one hand, you're saying there's better economic data, and you even mentioned business starts recently. But how can that be with the amount of small business that's gone through hardship and a lot of unemployment and so forth? Just speak to that perception of discrepancy and perhaps even how that fits into this, K-shaped kind of recovery and all.
Yeah, so when you look at the underlying data, there has been a bit of a negative trend on proprietor income, for example, or small business income. But it's been largely offset from what you would imagine based on, the companies that are large doing better. So, one way you can think about it is if you lose 10 jobs at a coffee shop where people were making $10 an hour, but you add 3 jobs to a firm where people were making $300,000 a year, it's going to more than offset the loss in income in the small business. Now, the human toll on that is devastating, but the financial toll in the short run is
for the economy as a whole, you're saying
almost not noticeable when you look at the averages, right? So I think from a moral standpoint, it's tough to watch, but from an economic standpoint, the averages don't see a whole lot of difference when it takes into account this K-shaped recovery.
And I talked about this previously, where the people with wealth and assets are, seeing significant benefit, where some of the people who are, maybe income only and not so much asset wealth, they're maybe having more challenges in the way the structure of the economy right now.
For sure. Which is why I'm a supporter of the additional benefits in the unemployment claims. So it used to be an additional $600 in your unemployment check.
Yeah, it's
which,
proposed another 400 this go around, and extending it out to September is what's proposed right now.
So, I'm very supportive of that idea, even beyond like the one-time checks. I mean, I think the one-time checks gets more fanfare, but if you collect many weeks of unemployment, then that money kind of builds up, and you can be
It's
more
targeted to who actually is, and probably more in need of it in that instance.
targeted
Yeah.
towards the people who are actually unemployed.
I'd like you to also just, well, if there's any other questions, this will be the last call for those. Feel free to chime in. One of the other things that I think can be a little confusing that I'd be happy to have you reiterate and explain. You mentioned the idea that interest rates might be rising when you talked about the curve, the yield curve. And I think that can get confusing for investors because we hear the Fed has plans to keep interest rates at near zero levels, quite a long time. So how is it that we're seeing interest rates rising?
Yeah, so the Fed controls the short term of the curve. So if you were to borrow in short term money, the Fed can kind of keep those prices low. But the longer end of the curve is usually, I say usually because sometimes the Fed does some activities to control this end of the curve as well. And there's some speculation that they will, but usually that's dominated by market forces. And what's happening is the market is foreseeing a recovery, some expected inflation, and the yield curve is rising on the further end. So when you see, the yield curve rise on the 6-7 year part of the curve, for example, that impacts mortgages. So mortgages will become more expensive. Credit cards are usually priced off of the short end of the curve. Corporate credit, for example, is often priced off of the longer end of the curve if companies want to borrow for a long time. So credit can become tighter if the longer end of the curve rises, even if the Fed is keeping the short end of the curve, very accommodative.
You mentioned real estate being an area of interest that we may put a little more exposure to in our portfolios. I'm sure other people might be questioning on the aspects of COVID experience and people moving away from the city and remote work. And, is there any expectation of long-term consequence to office parts of the real estate, malls when it comes to real estate? Where do you see this? How do you see this opportunity being attractive as you're looking to put money in this direction?
Yeah, the real estate market is a broad market, and there's a lot of different kind of assets in it, right? So commercial mortgage-backed securities, there might be a lot of opportunity there, but you need to actively look through to see what are the good credits and what are the bad credits. And this is one of the reasons why we're using an active manager in the space. We do think it's worth the slight additional extra cost to make sure that we find somebody that's able to find good credits and bad credits. I do want to mention that the mutual fund that we're going to use to get our real estate exposure invests across the capital structure, so and across different kinds of REITs. So we can have a mortgage REIT, which they only buy mortgages, and then they pass the proceeds off to the investor. Or they could buy an operating REIT, which is they buy they own an apartment building, for example. They manage the apartment building, they collect the rents, they pass on the proceeds to investors. So you can have commercial, you can have residential through the operating REIT that I mentioned. Malls are interesting. If you are in the individual stock portfolio, you might notice that I have continued to own a mall owner for an extended period of time, and even with the dramatic sell-off, I've continued to buy more and more and more of it. And that's because I believe that Class A malls, and the data proves this out to be true, are going to be very, very attractive, where Class B and C malls are likely to go away. So, it's one of those things where the devil's in the details, Chris. And I do think that you want some active management in that space.
Well, I think that's probably a good place for us to wrap things up, unless you have any parting comments, Brian.
I just look back on what we did in 2020, and I'm really proud of how we served our clients. and hoping to do the same in 2021. I actually think it's cost people not to be working with us in 2020. So I want to continue to keep up that trend in 2021.
All right, very good. Thank you all for being with us. And if you are thinking about any of these issues, you'd like greater clarification, if you find that maybe you've felt it's time for a sit down, a review, we're trying to do as much of that by virtual meeting right now, but we're happy to be in touch with you and go over whatever we can to check your situation out, whether it's your financial planning or the details of your portfolio design. Just reach out to us with a phone call, or you can connect with us by email or through the website. You can call us, of course, at 508-771-8900. With that, we're going to wrap up today, and thank you for being a participant. Oh, looks like we may have a question or two. What's up? We have one last question. How will energy stocks do? You did talk about this a little bit, Brian, but there's one question that we had about energy stocks, if you'd care to reiterate.
Yeah, so we only own them in the core Explorer space and in the individual stock portfolio. So if you and I don't plan on changing that. These are two places where we're typically with the clients who are can take a little bit more risk than our ETF and mutual fund standard cases. We've seen a rapid recovery in these positions, and it's been very, very, very good from a place where they were really in the doldrums. Oil in the United States at $50+ a share is profitable, and below $50 a share, it's arguably not profitable. So if we can stay above, right now West Texas Intermediate crude's at $53 a share. If we can stay above that point, I do think there's a nice runway for stocks. Now, oil is for oil stocks, but oil is a fickle commodity. I mean, if OPEC plus decides to start pumping more, we could see that fall back down to 40. And if they decide to cut more, then we could see it go to 60. I mean, if we see a rapid recovery, we could go to 60. What I like to do is acknowledge that these are very cyclical positions, and I like buying them at the bottom of the cycle. We're coming out of the bottom of the cycle, so I'm doing more selling of them right now than I am of buying them.
Excellent. Thank you, Brian. And if anyone has more questions, you can always send them to us. You can reach out to me at chris@amrfinancial.com. In the meantime, thanks everyone for being with us today. We'll leave you with a little bit of our disclosure language for our compliance firm. And if you have any questions, reach out. Thanks very much.